All right, good afternoon, everyone. Thank you for joining us in today's webinar. I'm Gab Aguila, Head of Research for Unicapital Securities. And for today's webinar, we'll be sharing with you updates on the global economy, as well as the Philippine equity markets. We likewise be sharing our views and recommendations on how you can best manage your investments given recent events, which make the current situation all the more challenging. Today, I will be joined by two distinguished speakers, Mr. Henry Herrera, a well-known expert, and Mr. Ben Thomas Pañares, the President and CEO of Unicapital Securities, Inc. And just a few reminders, as everyone is currently on listen-only mode, please feel free to ask any questions via the Q&A tab of the webinar interface or use the chat function to raise other concerns. We'll be having a Q&A panel session with our speakers towards the end. So without further ado, I would like to introduce our first speaker who will be sharing with us his outlook on the Philippine financial markets, its key risks and events to take note of, and its possible impact on the debt and equity markets. He's a well-known investment expert, passionate about sharing his thoughts and ideas on investing, and as such is known as Mr. Phil Investor. At present, he is also the chairman of the board of Ahon sa Hirap, a microfinance institution for the poor. In December 2021, he retired from the board of PruLife UK Philippines Incorporated, where he served as a chairman since August 2012 and as a member of the board of directors since 2010. He also served as a member of the board of the ATR Kim Eng Mutual Funds family and served as president and CEO of Sun Life of Canada Philippines and Sun Life Asset Management from 2007 to 2009. Let's welcome our guest for this afternoon, Mr. Henry Herrera.
Pleasant good afternoon to all. Thank you, Gab, for the introduction. Today, I will talk about the Philippine financial market outlook. Let me start by taking a quick look at some COVID-19 statistics. While we have seen a spike in new cases on account of the Omicron variant, new cases have since dropped. Despite a spike in new cases, daily deaths peaked at much lower level in February this year. Alert Level 1, which lifted mobility restrictions, has been in effect in NCR and most other parts of the country since early this month. Offices and establishments are allowed to operate at 100% capacity, and schools are preparing for face-to-face classes by the start of the school year. We will be playing catch-up with the other countries that have lifted mobility restrictions much earlier. As such, we are expecting a normalization of activities back to pre-pandemic levels. This bodes well for the business sector and the economy as the country has implemented one of the longest lockdowns since the pandemic started. In the week ending March 27, Department of Health reported 0 new severe and critical cases. Average daily new cases and deaths continue to decline. Vaccination levels continue to improve at 73% of target population and 75% for seniors and those with comorbidities. Let us now take a quick look at GDP growth rates for the top 6 global economies and the ASEAN 6. For most of the big economies, the World Bank expects slower growth this year compared to last year. This is on account of rising inflation, supply chain bottlenecks, and unwinding of fiscal and monetary policies. Please note from the table that the Philippines suffered the biggest GDP decline in 2020, a reversal from 6.1% growth in 2019 to a decline of 9.6% in 2020. The lockdown measures adopted by government, ECQ, MECQ, GCQ, and MGCQ took its toll on the Philippine economy. Thus, we expect a strong bounce as we head back to pre-pandemic economic activity. Nevertheless, as has often been the case, economies go back to previous growth patterns after crisis years. 2022 is no different as practically all 12 economies are projected to be on track on pre-pandemic growth patterns. The chart shows a continuation of economic growth if we black out the economic results for the last 2 years. As shown in the table, GDP growth among the emerging markets has been significantly higher than those in advanced economies, even prior to the pandemic. For 2022, among the ASEAN 6 countries, growth in the Philippine economy is projected to be the fastest. Let us now take a quick look at stock market returns in 2021 and year-to-date 2022. India topped the list among large economies with a return of 29% in 2021. Returns on stock markets in the US, Germany, and UK ranged from 16% to 27% last year. On a year-to-date basis, however, except for UK and India, the stock markets in these countries have reflected negative returns. Vietnam posted the highest return in 2021 among the 12 countries and is currently lagging the ASEAN 6 in terms of year-to-date returns. The stock market in China performed the worst last year and is again lagging this year. The crackdown on the technology, entertainment, and education sectors and issues on its real estate sector continue to weigh down on its market. Together with Malaysia, the performance for equity markets has lagged our peers in the region. The PSEI has marginally inched up by 1% since year-end 2020. It is not uncommon for investors to favor investing in asset classes, sectors, or even companies that have performed well in the past. This approach does not work well all the time. The caveat remains that past performance is not an indicator of future performance. It is not unusual to see asset classes or stocks that perform badly in one year perform very well the following year, and vice versa. Let us take a look at the PSEI's top gainers and losers last year and year to date. Five of the top six gainers last year among index stocks are now among the top losers this year. Emperador, Wilcon, Globe, Manila Water, and Ayala Energy were among the top gainers last year. Year to date, these same stocks are among the top losers. On the other hand, two of the top losing stocks last year are among this year's top gainers. These are JG Summit and SM Prime Holdings. We see another example of rotational buying and selling this time among the index stocks in the PSEI. Markets are forward-looking, and future earnings outlook and valuation metrics are key determinants of returns. Thus, rotational buying and selling among asset classes all the way down to individual stocks are not uncommon. After briefly tackling the returns on stocks, let us now take a look at the trends in bond yields. On the screen are the movements in yields on 10-year government bonds for the US and Philippines for 2021 and year to date. Notice the similarity in movements in yields, both for 2021 and year to date. Knowing this high correlation will help us better understand the bond market outlook this year. We shall go back to this later when we discuss the key risks as the US Fed starts raising interest rates on federal funds. At the beginning of 2021, yields on 10-year US government bonds stood at 0.9%. The very low interest rates have pushed many investors to switch to equity markets. Thus, the term TINA was coined. It stands for there is no alternative. Because interest rates are very low on fixed income instruments, a lot of funds have shifted into equity markets. Even when the returns on the yields on government bonds are way below inflation rates in the US. We have seen the yields on US bonds gradually increase last year. As inflation rate continues to rise in the US, the pace of increase in the yield on US government bonds accelerated. Year-to-date yield on 10-year government bonds has already increased by 90 basis points, much higher than the 60 basis points rise for the entire 2021. The Philippines, on the other hand, saw the yields on 10-year T-notes increase by 180 basis points last year and 100 basis points so far this year. As a result of the substantial increase in local interest rates last year, mutual funds invested in Philippine bonds mostly posted negative returns. The further increase in yields this year caused further losses in said mutual fund investments. Having had a glimpse of financial market performance last year and year to date, let us move into a discussion of some key financial indicators that may indicate or determine the outlook of the local bond and equity markets. NEDA's GDP growth forecast for the year 2022 ranges from 7% to 9%. This is substantially higher than those made by World Bank and ADB at 5.9% and 6% respectively. Also worth noting is that in all these three forecasts, the country's GDP by the end of 2022 will be bigger than the pre-pandemic level. The total GDP by the end of this year is estimated at 101% to 104% of pre-pandemic GDP. Next, we take a look at unemployment rates in the Philippines. Since about 70% of the Philippine economy is attributable to personal consumption, continued decline in the unemployment rate is critical to the attainment of GDP growth targets for the year. The unemployment rate continues to drop. At 6.4% in January this year, it remains higher than the pre-pandemic level of 4.6% in January 2020. As most parts of the country have been placed under Alert Level 1, lifting previous mobility restrictions and limitations on establishments, we expect to see further declines in the unemployment rates in the months ahead. This bodes well for the business sector and the economy alike. At this point, let me take another look at the yield on Philippine 10-year bonds, this time in relation to the inflation rate. We see another high correlation between the two indicators. And since we expect inflation to head higher in the short term due to the impact of higher oil prices, we may also expect the yield on 10-year Treasury notes to head higher as well. We know that as interest rates go higher, bond prices go lower. Thus, the outlook for bond investments in the short term is negative. This may not be the best time to lock in on long-term bonds as interest rates are expected to continue rising in the short term. Let us now move into the earnings outlook for various sectors in the PSEI. Banks are expected to post robust earnings growth this year on wider interest rate margins, lower loan loss provisioning, and increased lending activities. Continued recovery of the property sector and the conglomerate sector are similarly forecasted for 2022. With business activity going back to near normal levels this year, earnings growth in the PSEI listed companies is projected to be the highest in the last 4 years. On the valuation front, in terms of price-earnings ratio, we expect a reasonable overall PE ratio of 16.6 times for the PSEI, around the same level in 2019. We see opportunities in the banking sector, property sector, and conglomerate sector. The PE ratio for these sectors are seen to be lower versus the other sectors and also lower versus pre-pandemic PE ratios. Also, at the projected PE ratio of 16.6 times, the PSEI is trading at a discount to average PE multiple of 20 times since 2013, when the Philippines achieved investment grade status on its sovereign credit. Finally, we'd like to highlight the significant influence of net foreign buying and selling on the PSEI. In the years 2009 to 2012, 2014, and 2017, where we saw heavy net foreign buying, the PSEI posted strong gains. In the years 2013, 2016, and 2021, where net foreign participation was minimal, the PSEI hardly moved. The PSEI posted declines in the years where we saw heavy net foreign selling. If the next president is viewed positively by foreign fund managers, we may see them taking a strong interest in our local markets again. This was evident if we look at the years 2009 to 2012. During the tail end of the last global financial crisis in 2009, the PSEI rose 63%, while GDP grew by only 1.5%. Foreign fund managers have been net sellers in the PSEI for most of the last 4 years, practically negating the net foreign buying since 2012. Thus, the PSEI has languished below its all-time high of 9,058 achieved in January 2018. Keeping tab of net foreign activity in the PSEI will help the investor with the large cap holdings in the PSEI. In summary, stocks are favored over bonds this year. Positive GDP growth expectations, projected strong corporate earnings growth, and reasonable valuations are key factors. Further, rising interest rate expectations do not augur well for bond investments in the short term. Understanding that stock investments generally exhibit much higher volatility compared to bond investments, investors are cautioned to keep within their investment objectives, risk tolerance, and understanding of markets, among others. While your account officers and brokers at Unicapital may give you insights and advice, the ultimate responsibility for your investments falls solely on yourself. As with any investments, there are key risks and events that may alter the outlook of financial markets. A key risk factor is the projected rate hikes from the Federal Reserve Board on rising inflationary concerns in the US. The Fed has raised interest rate on federal funds by 25 basis points earlier this month, its first since 2018. The Fed signaled further rate increases for the balance of the year and possibly into next year. Inflation rate reached a 40-year high in the US early this year, and the Fed added that the war in Ukraine and related events are likely to create additional upward pressures on inflation. The last time the inflation rate in the US was at 7.9% was in 1982, and the yield on its 10-year government bonds at that time were near double digits. The Fed has to perform a balancing act in raising interest rates to curb inflation, while at the same time managing the magnitude and timing of the rate increase so as not to stifle economic activity. Inflation rate in the Philippines is far from reaching high levels at this time. It stood at 3% at the end of February. As such, the need for aggressive interest rate hikes by the BSP may not be in the same magnitude and urgency as with their US counterparts. We have also seen that the economic and fiscal challenges brought about by the pandemic has resulted in substantial increases in fiscal deficits and debts of practically all countries. As a result, some countries' credit rating outlooks were downgraded, and some even experienced credit rating downgrades. Debt to GDP ratios of most countries have ended much higher compared to pre-pandemic levels. On the chart, we see that US debt to GDP ratio rose from 105% in 2019 to 137% last year. The ratio is more than double their debt to GDP ratio prior to the last global financial crisis, which stood at 62%. The Philippines, on the other hand, saw its debt to GDP ratio also rise from 40% in 2019 to 61% last year, a level last seen in 2005. We've seen countries, in particular the PIGS, or Portugal, Italy, Greece, and Spain, go into debt crisis following the last global financial crisis. It bears watching if something similar will happen in the coming years, as equity markets globally were affected then. On the account of very low interest rates in the US, we have seen significant gains in the US stock market in the past 2 years as funds move into that particular investment class. This has brought about valuations to relatively expensive levels versus historical norms on several measures. Relative to fixed income instruments, valuations remain fairly reasonable. The situation may change as interest rates are expected to continue rising. At relatively expensive levels, increased volatility in US stocks may not be unexpected as the US equity market outlook may be under pressure. Other key risks include the endgame of the Russia-Ukraine conflict. Hopefully, the conflict ends sooner than later. We do hope that the conflict does not escalate and involve other countries, as the outlook for the financial markets may turn dim. Locally, the 2022 national elections are closely watched by investors, both local and foreign investors. A victory by a presidential candidate who is viewed positively by investors may see a re-rating of Philippine equities. We may see a return of net foreign buying into the PSEI that may push the index way higher than a lot may have anticipated. Finally, A new COVID strain or variant of concern may cause another delay on the return to normalcy and may lead to missed economic or corporate earnings targets. If the recent spike in new COVID cases is any indication, new variants may simply postpone the economic growth trajectory and not cause a reversal. In summary, the Philippine economy is expected to continue its recovery. Bond fund returns will be negatively impacted by the short-term interest rates as it continues to rise. We see strong earnings growth and reasonable valuation for PSEI-listed firms. Given this, we favor stocks over bonds. We reiterate that investment decisions must align with your objectives, risk tolerance, and understanding of markets, among others. Investment themes include an overweight in select banks, property counters, conglomerates, and other themed stocks. Consider diversifying into emerging markets as stock markets in advanced economies pause on extended valuations amid rising interest rates. Monitor key risks and events that may significantly alter the financial market outlook. Finally, while your Unicapital account officers and brokers will provide guidance for your investments, the final investment decision will be yours to make. Good afternoon once again, and thank you very much.